Good morning.
Good
Let me just
morning.
fix this a little bit. We have studious Jeff Yergi here with his glasses today. I think they look nice.
Thank you.
Returning, this is episode 3, Real Estate Education. We're going to be doing this on Thursdays. I'm Krista Campbell with Secure Property Management and Sales.
And I'm Jeff Yergi. I'm with GMH Mortgage. I'm a senior loan officer. We're out of Pennsylvania, and we have an office here in Sterling, Virginia.
Today we're going to talk about credit and how it impacts your home purchase process. We have quite a few topics that are important, talking about Credit Karma versus your FICO score and why it's important. Go ahead, Jeff.
Well, here's what happens. Most people get sucked into it's free, doesn't cost you anything, we'll update your credit scores, we'll keep you posted on any changes, and those things are all fine and dandy. But from a mortgage standpoint or a financial standpoint, even if you're buying a car, your credit scores are going to be different because we're utilizing a different credit reporting agency to pull your credit information. So there's 3 credit bureaus, Equifax, Experian, and TransUnion, and they all report differently, and not all your creditors report to each and every one of those companies. So your scores are going to be different from one company to another.
So if somebody's looking at their Credit Karma and says, well, my Credit Karma says 620, it might be, I guess, lower on your FICO score, right?
It could be, and it could be higher. It really is different. I think the best advice that I could give is to just make sure you pay your bills on time. I think keep in touch with your credit report, follow any activity. Credit Karma is good, at least for reporting any kind of activity that's taking place. But they're only reporting 2 of the 3 bureaus as well. They're not reporting all 3.
That's right. They don't have 3 on there. Well, if somebody is in rebuild mode, what would you suggest that they do?
If they're in rebuild mode, before you do anything, paying off collections and so forth, you should talk with me. Let's review your credit first and come up with a plan of action in order to figure out what's best. Sometimes paying off debt, especially collections, will hurt your credit rating.
Oh yeah,
Because
I've heard that too before.
It creates new activity. So if you suddenly now pay it off, it's new activity, gets recorded, the credit bureau is paid. Now you've started to clock over.
Yeah.
And if they're medical related, most mortgage companies don't require them to be paid off if they're not significant amounts.
Oh yeah.
So that's another one of those things. So I guess overall it's important that you sit down and talk with us before you just go decide to pay things off. Or
I always tell people, don't do anything. Just go
Right.
talk to a loan officer first, because you're kind of like a credit counselor. If somebody doesn't have any credit, or if somebody's trying to rebuild their credit, they really need to find out the do's and don'ts first before you actually make moves, because people think just pay everything off, and that's not the answer.
No, it's really not. And I think you have to really have that plan of action. And I've been doing this for a long time. And
How many years now?
25.
25 years.
And it's been enjoyable.
Since I'm only 29, that's more than half my life.
That is correct.
29 and holding, I should say.
There you go. The collections are different than the judgments. So judgments typically are going to be required to be paid off, or at least have some type of repayment plan in place as well. So again, everybody's situation is really different, and we would have to analyze the credit, set up a plan of action, and get them on going down the path of reestablishing themselves.
And that's the important thing, is the plan of action, because sometimes I say, a year in advance is not too far in advance, because you have to give the time to get everything together.
That is correct. And especially if you have no credit, I mean, you have to be able to build credit.
So what would you suggest for somebody who has zero credit, just zero?
Well, the good thing nowadays is there's a lot of companies that offer secured credit cards, or they offer a higher interest rate credit card where you pay an annual fee just to get yourself started. You may start out with a very small limit, like $300 or $500, but it's a start. You have to have credit in order to buy a home.
How many lines of credit would you suggest that people open up?
I think 4 is a good number.
Okay.
It gives and you can have 4 credit cards. You can have a car payment. If you can get a car loan, that would be awesome. Installment loans help. Department store cards are good as well. Maybe get a secured line of credit.
Well, okay, say for example somebody gets a card, $1,000 limit. What percentage would you suggest using? Obviously you don't go max it. Would you say 30%, 50%, 70%? What's the line, and how much should you pay on it monthly? Should you pay it off?
Well, okay, so you're right. 30 to 50% of the line is always the rule. It'll help get you a better credit score. If you can keep it between that 30 and 50%, you're going to do really well.
Okay.
Paying it off is not a bad thing, but you need to use it. So some months maybe you want to pay it off, and maybe for 2 or 3 months in a row you don't pay it off, because what you're doing is building a credit history and establishing that you're able to use credit and be responsible.
Yeah, responsibly using it. Okay. Well, let's go back to rebuild mode and say, for example, life happened, somebody has bankruptcy, and with different types of loans, we know they have different waiting periods, which means after that happens, you have to wait a certain amount of time. So if I filed bankruptcy, how long would I have to wait for a VA loan?
Okay, for bankruptcies, it's 2 years.
Okay.
As long as it was just, on your own personal debt, it wasn't a business bankruptcy. 2 years is the rule.
So you said business. So if you have your own business, there's a longer waiting period?
Yeah, well, those are different types of bankruptcies.
Okay.
Okay, so if
Learning
you're in
something new
Chapter
today.
13, if you're in a personal Chapter 13, which is a reconstructed, usually they're looking for half of that to be paid back before it would be considered as well.
Okay.
So, but with a standard bankruptcy, personal, you're looking at 2 years as long as you didn't include a home in the bankruptcy,
Okay.
and you need to reestablish credit. So what happens after going through bankruptcy, you get creditors sending you credit card applications because now you have no debt.
Yeah.
The
True.
slate's been wiped clean.
Just like when you buy a house, they all want to send you.
Right, that is exactly
Credit.
right. And what happens is you're going to start out with high interest rate credit cards. Unfortunately, that's just how it works. But if you can be responsible and maintain those limits and keep the balances down, that's going to help you rebuild your credit faster than maxing your credit card out.
Oh, yeah.
Keeping the balance up there, making only the minimum payment. You're just going to continue the pain and extend the period of time it's going to take to do so.
Now, we talked about the different types of loans having different waiting periods. So what's an FHA loan?
Well, bankruptcy, again, FHA is 2 years without property. Once you include a home or you have a short sale, you're looking at 3 years.
Okay.
So, and again, everything involves reestablishing credit.
Well, I've heard before they try to make short sales seem less impactful, but they're really treated the same as foreclosures.
Yes, that is correct. There is no difference between a short sale and a foreclosure in respect from a lending standpoint.
Yeah. Now, what about conventional loans? Because those are the three main types: the VA, FHA, and the conventional.
You're talking 4 years on foreclosures for conventional.
What about bankruptcy? Same thing?
No, bankruptcy will still be 2 years as long as you didn't include a home.
So bankruptcy is actually better.
Right. If you had a well, from that standpoint, yeah. I mean, people run into situations in life, and typically, it's usually medical related of some fashion, or a divorce, and those kinds of things really change people's lives in a fashion where you need time to rebuild.
Yeah.
And fortunately and unfortunately, we have a system in place that allows you to do so.
Okay.
I mean, you can't file bankruptcy, I think you can only do a second one 8 years. It's 8 years after you've had another one.
I just want to say hi to Jose. Thank you for joining, Jose.
Hey, Jose.
This is Jeff Yergi. What's up, Charles?
Nice to meet you, Charles.
Give us the likes, loves, and shares if we've said something you guys like. You can even tap the mad face if we've ticked you off or something. We really appreciate the fact that you guys joined in here. But we're just talking credit and how it impacts home ownership, basically, and the different waiting periods. Now, let me ask you, what about student loan debt?
Student loans are treated differently than they used to be. If they were in deferment for 3 years, you didn't have to count the payment.
Yeah.
Well, that's all changed.
When did
because,
that change?
in the last couple of years, I would think it's all gradually taken an impact. Now you're required to count a minimum. If you can't establish what the actual payments are going to be on these student loans, there's a formula all set up for what percentage you have to count based on each type of financing. And that's a little cheat sheet somewhere that each one's a little different. But for example, you might have to count 1 or 2% of the balance, of the balance. So if it's $20,000, you're still going to have to count, $100, $200 a month payment against them to qualify. And that's because those loans do come due, even if they're in deferment. And they found this was one of the things that led people to going foreclosure and short sale because they didn't have to qualify with those payments.
Yeah, that's so true. Because a lot of people, like myself, we can rack up a lot of student loan debt. I have a lot.
Yes.
I told you I have 2 master's degrees, so I have quite a few in student loan debt.
Sure.
But and the one other thing I want to talk about though is debt to income ratios. What does that mean to someone who's trying to get a loan?
Well, it's important. Just because you have a good job and you make money, you might be overextended with your debt. I know a lot of people in my years in this that never were late on anything, but they were maxed out. I mean, they were overextended. They had a lot of credit cards. They had car loans, student loans, personal loans, second mortgages, and their credit scores were impacted by that. And
not Credit Karma.
No, right, exactly.
Your FICO score.
That's right. I think everybody's situation is different, but there's some boundaries that are set in place for each type of lending, like your standard conventional loan, under the max limit for conforming loan is 417 currently, getting ready to increase to 424, 426 and change. The debt to income ratio is 28% based on the housing expense, divided by your gross monthly income.
That's a lot of numbers right now.
Exactly. I'm sorry. I'll make it a little shorter.
No, it's okay. That's what you do.
Then the housing payment plus your monthly debt is what is the back ratio. So that's typically 36%. Now, under circumstances in automated underwriting, they allow for increases to those qualifying ratios. And again, it's going to be based on credit, time on your job, assets in the bank. Sometimes it's down payment that'll impact that as well. And I've seen as high as 50% on the back end ratio being acceptable. So automated underwriting will dictate a lot of those things.
The bottom line is it just is not a cookie cutter answer.
No, it's really not.
There's so many variables that go into getting you pre-approved. It's just ridiculous.
It is. They're trying to streamline it. The CFPB, which is the Consumer Finance Protection Bureau, they're all working at trying to make things easier, but really they're making things more complicated.
Of course, that's what they do.
That's exactly right. So we're in this situation, unfortunately, but it's live and learn. And we're always education is continuous in this industry.
Well, things change every 6 months, a year?
It seems that way.
Yeah.
And the amount of regulation that goes on with it, and things you can do and can't do, break down the marketing and how you can market and so on and so forth. It's a revolving door.
Well, one more question, and then we're going to cut it off for today. What is the bottom line credit score that you can accept?
Well, we can go with as low as 600 as a middle score with FHA financing.
Now, I don't want to interrupt you, but you said middle score. So what does that mean? Because not everybody knows that.
That's a good point. So we'll take a step back. Each credit bureau gives you a credit score, and from a lending standpoint, we use the middle of the 3.
Okay.
We don't average the 3. We don't use the highest one. We don't use the lowest one. It's, in all fairness,
it's
the
median?
middle.
Is that a mathematical term?
Yes,
Median.
median. Yes, that would be correct. And so if you have 700 and 680 and 675, we're going to use the 680.
Okay.
And that can be a difference in a whole nother segment about how it impacts your interest rate.
Yeah, definitely. We're gonna have to talk about that one. But if we said something you liked, if you said something you loved, or if you know someone that may be benefited by hearing this, please tag them in it. We love the likes, loves, and shares. We thank you for watching today, and if you have any questions, concerns, or topic suggestions, please get with me. You can direct message me. I am also on Twitter, and you can call me or text me at 571-436-5104. I am with Secure Property Management and Sales out of Fredericksburg, Virginia.
And you can reach me at 703-472-4760. And again, I am with GMH Mortgage. We're out of Sterling, Virginia. And thanks again for joining us.
Thanks so much. Have a good day, and Happy New Year.